2 years in a row of 20% plus market returns, AI's productivity revolution, and a fundamental shift in the relationship between stocks and bonds. Welcome to 2025's investment landscape. Today, BlackRock's Rieder is with me to examine how the current market landscape could reshape our thinking of portfolio allocation. We're going to discuss that and more right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Good to be with you today. Even better to be with my guest, Rick Rieder, Chief Investment Officer and the Head of Global Fixed Income at BlackRock. Rick, always nice to have you.
Thanks
for joining us.
Fun. I appreciate it. Thank you.
This is the first time we're speaking this year so far. We haven't had you for a couple of months, and I wanted to start with the economy because that seems to be the thing that's on everyone's mind. We can go through all the economic data that we've seen recently, but I just wanted to kind of get a sense from you of where you see the market and the economy right now as we sit here.
So I would say, I've been doing this a really long time. I would say the error band around how you predict the economy and inflation is probably as wide as it's ever been. Like
right.
Anticipating what we're going to do with tariffs, what we're going to do with how we systemically deglobalize, deregulation. So anyway, that's a bad answer, but it is. So what do you do with that? I do one of these monthly calls where I'm talking about sometimes you have to pull back from the headlines, think about the structural dynamics. Structural dynamics in the U.S. economy are still pretty good. In fact, they're arguably very good. Where you still got 4% unemployment. Immigration is going to drag a bit. You still got good real wage growth, and you've got a delevered economy other than the government. That usually leads to some pretty good growth. However, you're starting to see some moderation, but there's seasonals at play that are pretty extraordinary. So we had the same thing happen last year. You tend to get some bending down of the growth, and you've seen that recently in some of the surveys, some of the retail data. Mm-hmm. So listen, I still think net, I still think you're going to grow 1.5% real this year. I think you can get nominal still well into the fours, but listen, we got to watch the data. We've had some pretty strong growth. It's pretty hard to predict the timing of dereg and the impact on dereg and other stimulus. Can I say one thing on inflation? I brought
Please.
A couple of charts because I'd feel completely exposed if I didn't have my charts with me. But I had two cool charts that I think for for the economy, think about inflation and the markets. I think it's a big deal. One is, what I show here is just the seasonals of inflation. Mm-hmm. There's something that's happened over the last 3 or 4 years where companies actually roll over contracts at the beginning of the year. And so you see this big inflation that happens at the beginning of the year. Things like you wouldn't believe the impact they have, waste management, other things. So what I show here is core PCE, and you saw core CPI, you saw a strong report. It tends to peak and then it comes down. My guess is you're going to start to see some better numbers that'll come over the next 2-3 months, similar to what we saw in the last couple of years. So one thing people said when CPI came out, my God, we can't get the inflation down. I still think inflation is going to be sticky high, and I think it's going to preclude the Fed from moving till the back half of the year. But anyway, I'm encouraged that if tariffs notwithstanding, you're going to get some price level adjustment from tariffs, and we are going to get tariffs. But you're going to see some improvement. I just one last graph that if I can show you. Here's what I think is a really big deal, and we're seeing this in flows, and we're seeing this client demand. There's something very unique here in the U.S. and in Europe. The Fed, we could argue, did the Fed do this or the system do this? But inflation has come down several hundred basis points. The U.S. economy is pretty amazing how flexible it is and how it adapts and what have you. Inflation has come down to we could debate mid to high twos, but if you look at, you're pretty close to the long-term trend line. The beauty of this for income and for the reason why we're seeing huge demand in income products, until you get to the last mile, the Fed can't cut rates. Mm-hmm. So what Fed was at a restrictive rate, you think about when we were 300 basis points ago in inflation, now we're in the last mile and the Fed can't move for a bit. What that means is you can create income in a portfolio. You can build 6.5%, 7% yielding portfolios. Inflation's running, let's say it's 3 for a round number. Your real rate is pretty darn attractive. And so just because we haven't closed out the last mile, and the Fed's got to keep the rate here, it's a pretty cool time to buy. And this is why you're seeing these flows in income today.
That's what I want to get into with you too. But do you say, even with the 10-year Treasury yield, it's starting to finally decline a little bit over the last, I don't know, 2-3 weeks or so. Now it's about a 4.3%. Not even near the lows we saw last September when it was 3.6. Does that play into your expectations for the Fed and investing in fixed income?
So I'd say a couple.
Because are we going to get those high? Are we going to get those high rates again? Those returns?
So I'd say a couple of things. One, I think the back end, go 10 years and longer. I still think it's not a great investment vehicle. The Treasury's got to still issue a tremendous amount of debt. We got to deal with issues around tariffs, how that's going to impact inflation. And quite frankly, the yield curve is still pretty flat. I love owning the 2 to 5 year part of the curve and buying as much income on it as possible. Keeps my volatility down, keeps me more stable. Listen, I wouldn't rule out today that you're going to see some numbers that could create a bit more inflation, even though I think it's trending lower, and that it's hard to buy. Do you really need to buy the long end? What is supporting the long end today? There is pension, life insurance money that these yields fit where they can functionally defease their liabilities. So there's demand there for the long end. I think for any individual foundation, endowment, if you say, gosh, I can create that income, stay stable and be in the front of the belly, that to me. And by the way, if growth is slower than we anticipate, Fed's going to start cutting. And then the front end is you're going to have a curve steepener of significant magnitude.
Right. I mean, we're finally seeing a normal curve after it was inverted for 2+ years. With the twos finally down at whatever 410 or so, in that range. What about consumer confidence just came out and it really dropped significantly. Does that play when you look at portfolio allocation and the way that people are investing and advisors are looking at their client portfolios, and you see that consumer confidence dip so significantly, does that give you any pause on where we think the market might be headed? Will people pull away? Do you think they're going to start to invest more? I know it's a big philosophical question.
So on one thing, and maybe I'm just stubborn or I haven't done this for a long time, I think surveys don't really tell you much. And in fact, it was interesting. I'm actually doing this monthly call where I'm showing that if you track consumer confidence and spending, people there was a point in time, you go back a couple of years ago, it was the lowest level of consumer confidence and they were spending like crazy. And so, but what really drives spending is jobs, income levels, wealth. And if you take, now there's a part of the low end of the consumer that's having a hard time, and it's part of why the Fed had to get 100 basis points off the rate. If you take the rest of it, you've got all the impetus for spending. Listen, I think what I do watch like a hawk, when Walmart tells you their numbers are spectacular, but maybe coming down a little bit, the auto companies a bit softer, quick serve restaurants a bit softer, that stuff, real data, that caused me, so I think, and Brewer, we're talking about, I think you have to be respectful of the data bending down a little bit, and I think you got to watch it carefully. And then, by the way, there's some other areas of consumption. Travel, ripping along quite nicely. Apparel was pretty good.
Right.
My sense is good economy. You got all the ballast behind you for the economy moving along, consumption moving along. But if you set at the margin, would you come off a little bit? And so much of this is on what is policy.
Right.
And,
right. Well, a lot of that is unknown and ahead of us. And like you said, tariffs are inevitable. We'll have to see how that plays out and what the actual numbers are once the negotiations begin. I do want to ask you, Rick, of course, you're the bond king. So, when we sit here and talk about investing in 2025, and given the landscape that you've just presented, which makes a lot of sense, you kind of say in a recent report that the role of bonds as a hedge is kind of no longer reliable. What do you mean by that?
Yeah, I think it's archaic. I think and by the way, if growth really slows, do bonds help you? And it gets to the point of, actually the front end helps you because you're steeping like crazy. If you go back in time and say, why did it work? Why did bonds work as a hedge? We used to have a manufacturing, cyclical, commodity-oriented economy. Fuel prices came down, the economy ripped. It's nowhere near that anymore. And the banks are asset liability matched. The interest rate tool is just not that effective at moderating the economy. And the big companies don't borrow anymore. So I don't really believe in that. What I believe in today that I think is absolutely durable is this idea of I don't need, people say I got to buy fixed income or I got to buy bonds to hedge my equities. I just think buy equities and buy as many as you want. And I've learned over my career, the best hedge is sell what you don't want or reduce your exposure.
Right.
By the way, there are options. There's, do you rotate, into a more market cap weighted versus concentrated?
Gold is a good hedge as well.
And gold has been an unbelievable hedge. And by the way,
hedge.
I think real assets are in fact a hedge because the risk is the debt and the currency. And you could have a currency issue in the country. What I think is, if you said to me, build, I would say for me, what I think is a good portfolio today, I take the risk on taking equities. I still think equities will do their job. And then I'd buy a bunch of income. And whether it's, funds we run or, parts of the income producing market, and we can talk about preps or REITs or what have you. If I can clip that sort of income, keep my volatility at a reasonable level, own the amount of equities, and then, like you say, real assets. And by the way, cash deserves a seat at the table.
Sure.
Cash works beautifully when other stuff goes down.
Yeah, I mean, liquidity is a great component to have in any portfolio. You always want that, in the case that you need something, an emergency fund or what have you.
By the way, I got to one last point.
Please.
11 of the last 14 CPI reports, if it surprised strong or weak, the bond market and the equity market did exactly the same thing. Meaning, if inflation is our instigant to move prices around, it's going to hit bonds and stocks the same way.
Right.
It's part of why I just think that gosh, I'm using bonds to hedge. Doesn't make a lot of sense.
And you kind of alluded earlier that you think the Fed might have to wait a little bit down the road. I mean, there's a lot that's unknown right now in our economy. So do you still think, we think 50 basis points is coming off the table before the end of the year. That's our CIO view here at UBS. Do you have any view on what the Fed might do?
So my view has evolved a little bit in the last couple of weeks, but I think it's fair. And I think the Fed would like to get 50 off. I think they'd like to approach what is the normal terminal rate or the neutral rate. Listen, I think inflation's too sticky, and I think the economy's too strong today for them to do it. If you said to me, what is the thing I'm most focused on? There's going to be the trend on payroll. Immigration's a really big deal. I've been blown away the last few weeks looking at, you got to give the president credit or not, in terms of what, how it's affecting labor and how it affects nominal GDP. But it is different. It is different.
Right.
And we hired millions of people through immigration in healthcare and teaching and restaurants and hotels, and that is going the other way. We're certainly not going to get the net influx. So listen, I think we got to watch the hiring thing. And if you start to see some softness in wages and you see some softness in the numbers we're hiring, then it opens the door to the Fed. Do I think the Fed can go in March? Nope. Do I think the Fed, I think it's dubious. I think you need a couple of months of soft labor conditions. But immigration is going to, and by the way, the one that also has hit me was recently the government hiring, which is a big part of, like, the Doge thing is real. Like, you talk about, that's going to be an impact over the next few months.
Yeah, people are losing their jobs.
Totally.
Right.
And so, that's going to be, the labor numbers are going to be significant. I'm pretty confident, save what happens to tariffs, it'll take some time to implement. I'm pretty confident we'll see some inflation numbers that will get you close enough on a core PCE level that they'd be able to move. It's labor that's a big deal.
Before we go, what are your thoughts right now on the continuing artificial intelligence story related to our industry or just multi-industry in general? Still room to grow?
I think I'm doing a presentation, I'm doing one of these monthly calls where I'm showing the development of the light bulb. I think it's a big deal. I think it's a really big deal. I think compute is where the world is going, and AI, and I think people are grossly underestimating. By the way, inflation can stay sticky for a while. I think people underestimate productivity and automation and AI influence that it's going to have on so many industries. We talk about labor as well. Like, I'm pretty blown away by what is going to happen. And so, we could debate software implementation. Do you buy analog? Do you buy pure compute? Do you buy software? There's some evolution of where that goes. But there's no question in my mind, the spend and the development of productivity, automation, robotics in all fields, not just traditional technology, healthcare, industrialization, et cetera, it's a big deal.
Yeah.
And I would still, investment-wise, I find it hard to see anything that challenges that as being the best investment. By the way, in companies, there's some big retailers, the Walmarts, obviously the Amazons, the Ubers in a different form that are utilizing data effectively at scale, like that, using automation and productivity. That's a way to get in there. And then like I say, in healthcare, some of these robotic surgical instrument companies, diagnostics. Like I think by the way, you go back to GLP-1 and technology's influence, I think is going to be, to me, I'd rather lend money in traditional businesses, buy equities where I think technology and innovation is happening.
That's incredible. And people worry about the AI taking jobs, and it may mitigate some tasks, but it's opening up new jobs. There have to be developers and people who are running the content.
And I was thinking about, as I'm coming up the elevator, I'm thinking about like, what's the one
Yeah,
technology?
what's the big technology thing for you?
So because I'm a big believer in robotics, and I haven't got it yet, which is a tricky thing for me, is I think everybody by 2027, most people, and certainly most everybody by 2020 will have their own robot. I think, by the way, I looked at one of these robotic dogs. I said to my wife, I'm getting one of those robot dogs. And then I went in to see it, and it's like eerie. The whole thing is eerie. So I'm going to wait on the dog.
I don't disagree with you on the eeriness of it all, yeah.
And I don't know, that one. but I think everybody, so I'm waiting to when the price comes down. So I think Elon, and I think people will bring down the cost of robots, and I'm looking forward to not taking the garbage out. Like, it's going to be, but I think everybody's going to have their own robot.
I mean, we've been fantasizing about robots since we were children, watching the cartoons like the Jetsons or Star Wars. I've always wanted my own R2-D2 running around the house. Might actually be a reality.
We are really close. We are. By the way, it also comes with some freaky stuff alongside of it. So, including who gets your data, where does your data go regionally. So I don't know. That's part of why I didn't want the dog.
You got to get a strong VPN in the house for that dog, right?
That is true.
Thank you, Rick. Good stuff. Great to see you
Anthony.
as always, Rick Rieder from BlackRock. And thank you all for joining us. Lots more information from our best partners like BlackRock and others at ubs.com/views. That's our Insights website, and also information from our Chief Investment Office here at UBS. You can also follow all of our content on social media. We're on all the major channels, including Instagram at UBS Trending is where you're going to find studios content. And plus, you can follow UBS on LinkedIn, Facebook, and X. And as always, if you have any questions about what Rick and I spoke about today, make sure you're reaching out to your financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.